Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting with Joel Elconin. We're going to be talking about this broad move in commodities higher, and in all fairness, the US markets also getting bought back here. Seems to be just kind of this bullish environment across the board for investors that is also widening out. And I think that's one main thing that we have seen in the commodities sector as well. Joel is the co host of the Benzinga Pre Market Prep Show, also editor of the Pre-Market Prep website. Joel, let's start with commodities and some of the bigger commodity sectors, more the headline commodity sectors where gold has continued its breakout. Copper has also moved above $4, about 5% above that $4 target, a little above 420. Crude is closing in on $90 a barrel. These are, again, some of the headline commodities that are continuing to get a buy here. They ended last quarter strong, and they sure started April on a strong note. What's driving these commodity moves here in your eyes, Joel?
Good afternoon, gentlemen. Thanks for having me. It's a confluence of different things. There could be some good implications and some bad implications of everything. I just want to say congratulations to all those holders of gold, and I'm one of them making a big move. It's just a rotation, and it's into the metals, it's into the commodities prices, and that's just what you're seeing. I think that the actions of the Fed are kind of indecisive. At least they say one thing and another one says another thing. So it's just a rotation, and now the other rotation is into the commodities and gold. Now, if you want to look longer term and look at it from a inflation perspective, it's not the greatest thing. But no, gold's cut a nice bid. Silver's playing a little bit of catch up. Maybe people are, taking a little money out of Bitcoin and diversifying with the metals. So it's just, story, rotation, anticipation of the Fed lowering rates, all favorable for the gold and the commodities.
Well, Joel, I got two questions for you back to back. One, are you going to sell your gold now that it's way above 1900? And two, when you look at Dr. Copper and we look at oil, the other thing in the commodities is those, Dr. Copper is the health of the manufacturing and the economy and electricity. And crude is the tax on everything. And as that goes up and as gas prices go up, it can affect the inflation numbers. What do you think about those two commodities popping their heads higher?
Well, sell is a four-letter word. You know that in the markets. You just got to hodl. Got to hold on for dear life. So no, have it in a couple portfolios. Been in there since COVID. A little diversification play. Nothing to take home to the bank. So just sticking with that position. Now it's easy. Now that it's broken out, it's much easier to trade it technically, just being in that range for so long and the fades and everything. Now to me, there's a little bit more discernible patterns, but don't have any place to take the money out of the gold really to put it into at this point. And then I'm sorry, your second question pertained to.
Dr. Copper and oil popping their heads up.
Yes. Well, I mean, a couple things that, we'll get some of that data next week, right? And whether or not that will be reflected in the data, when did they take it? Did they take it when crude was at 75, 76? There's always a lag effect. So the inflation numbers were not great last month, and market's very optimistic here with today's rally, even with the rally in crude. Now you can look at copper at a couple different perspectives. One, you can look at it from an optimistic point of view that hey, we're still building, we're still housing, infrastructure, buildings. That's good. That's good. The economy's still humming. If you want to look at from an if you're building or you're going to need copper from the inflation perspective, it's not a good thing. But I think overall, what you're seeing in the market today from the relief of the jobs numbers is everything is still okay. The other thing that I read about copper, and don't quote me on this, and I don't have an exact source, but they're talking about like the data centers and all the AI, right? All the infrastructure that's needed to complete the manufacturing of these chips that are going to be needed so much. So I don't want to call copper an AI play But if you want to use a stretch of the imagination, you could put it in that category. Perhaps that's another reason for some of its recent strength.
So, Joel, let's look big picture at this because, look, a lot of people waiting on these rate cuts, but now even the market, I think, is factoring in, pricing in only about 2.5 cuts this year. So the market has started to discount even more rate cuts. We're seeing the US dollar higher. We're seeing almost everything higher along with some better economic data. So, how do you navigate this environment where it seems like you would think, with the market factoring in less rate cuts, that markets would pull back, that a lot of other things would pull back, and that's just not what we're seeing?
Can have your cake and eat it too. Okay. I mean, I don't think the market really needs rate cuts. I think the people that are, predicating their investment thesis on lower rates or rates going back to zero, you have to look at right now. Rates are still low. Okay, rates on a historical basis are still low. I got my first mortgage. Okay, it was double digits. Okay, I was so happy when it went up into single digits. So historically, we are still at a low interest rate environment. People have to appreciate that. It's not good to go back down to those lower rates. I could see rates staying between 3 and 5% for a decade. Are
Well,
you guys still there?
yeah, I was stunned when I was hearing that, like, 'cause that would be a long time for them to stay like that. That would be good for people that have money on the sidelines, though, in money markets and in CDs. So
Yes.
that would be. I know that you like stable for longer, Joel, but what about the fact that the bonds keep selling off? And if they keep selling off, it's eventually going to push rates higher. Do you think that the Fed or other central banks in their native areas are going to have to respond to falling
Yes.
bond prices?
Yes, yes. I mean, the TLT, I mean, any way you look at it, the TLT is having a horrible day. I mean, the bond, they're telling you this rally ain't gonna hold, is what they're telling you. Now, you've seen them diverge for times. Who knows what the data is going to come along. I think you had a little fluff yesterday, maybe, in the TLT and the bonds because, with Israel and, everything that's going on, you might have had a little flight to quality. But there's no way that you can look at the way the TLT, the way the 30-year bond has come off that December high to be thinking that rates. But, they keep saying, oh yeah, the Fed's going to do this. The Fed's going to do this. Well, Kashkari came out yesterday and kicked everyone aside the head and said, "Listen, this is the way it is." So they speak out of both ends of their mouth. Powell, whatever. He's navigated us through COVID. He's navigated us through the last two presidencies. I just don't see the need for the cuts. But it'll be too late, right? Right? Everyone says you got to be ahead of the curve. Apple laid off 600 people. Huh, they have 160,000 people. You did have some other tech layoffs, right? But when's that going to filter through the system? I mean, I don't think I've ever seen the market at like more of like a battleground over higher rates or lower rates. Everyone's arguing about it. Well, why don't everyone just come to agreement that rates are going to stay where they are and the stability for these rates? Let the banks figure out, after loaning money out at 1% and now paying out 5%, let some of this stuff roll off the balance sheet. Try and get flat, and that's what stable for longer is going to do.
And that's what we've seen, though, right? Everyone's trying to predict a rate cut. When's it coming? And the Fed has been saying that, look, they are coming, but quite frankly, they keep pushing them off. And this higher for longer or stable for longer has been the narrative for a long time. And we've continued to see markets benefit from this. Now, Joel, let's look at the markets because they ended yesterday on a very bad note. It was almost a waterfall decline in the last about hour and a half, almost 2 hours of trading, but they're being bought back a little bit today. They're looking like they might close the week a little bit negative, but again, it was almost the buy the dip today that we are seeing again. These markets broadly, I know they're not just being carried by the Magnificent Seven. What's your outlook for them? Can this strength continue?
You know what though? There's a lot of people that bought the dip yesterday that were praying. You know, because the market went well beyond last week's low. So unless you were scaling in or you tried your buy and then you cut bait, and it came close. Now, did I ever tell you guys about the Friday rule? The propensity of the market to make highs or lows for the week on Friday. And that's exactly what you had this week. And last week, not so much. But you had your low on Thursday. They just there was kind of panic selling near the close, maybe a little bit of margin selling. You take out the pre-market low by a couple ticks. You challenge the pre-market low in the regular session. You can't take it to. I mean, that was what everyone was waiting for was the index to take out yesterday's low, for stocks to take out yesterday's low, and it didn't. So then you know what happens? You get a hot jobs number. That doesn't break the market. Now, people, on my earlier broadcasts, they're like, "Oh, you just wait. You wait to the people are stacking their stops at yesterday's low. You watch out. They're going to come and get it." And you know what I said to that person? I said, "What about the people that think they missed the dip? What about them? They're going to be big. Like you got to be scratching your head after it did it. Then here you go. You just like when you come. Another rule of technical analysis is what I tell you guys. When it goes down quickly through an area, it can go back up just as quickly. That's what you're seeing today. S&P's up 70 handles, still down on the week 40 handles. Who knows what's going to happen going into the session? But it's your stocks that don't need money. It's your cash strong stocks. Apple doesn't need money. Microsoft doesn't need money. Nvidia doesn't need money. Google doesn't need money. Amazon, Meta, these stocks, AMD, cash cows. Now, what is your interest rate sensitive stocks? I'll just take a look at something like, solar. Solar down, EMPH down 581. The TAN, that other thing never really represents anything. So, it's just separation here back to the companies that are making the money, back to the companies that have cash, back to the companies that don't have to go to the wealth to support their business.
Well, Joel, you referenced the Magnificent Seven there. This week, the Wall Street Journal came out with an article and said the Magnificent Seven are now the Fab Four, and they were kind of taking a shot at Apple, Tesla, and Alphabet, Google, that they weren't doing as good and that the only four.
Well, what are they doing? Do you know Google made a new all-time high this week?
This is what the article is. I guess the point was that Nvidia, Meta, Microsoft, and Amazon, they're saying as the Fab Four now. My question for you is, do you think that people are finally getting out into other areas of the market, that it's broadening out, that you're seeing some of that tech money, big tech money, while it's still doing well, start saying, hey, what other sectors could be running? Are you seeing that when you look at other sectors?
I mean, oil's picked up, and I've been lacking on this oil rally. Corresponding with crude, missed a chance for some diversification here. The market seems to be warming up the financials here. Even just that a lot of that was anticipated in rates, but with the financials, more stability. Just banks not going under is a good thing. So your banks, your big stocks. The IWM, I mean that thing bounces around like a ping pong ball. Really hard to hold a rally. But that's holding up okay. So the rotation of small caps will really get going is when you start getting those interest rate cuts. So just people are going back to what works and, magnificent. I mean, people love to make up names. I know what you're going to ask me about next. And I would say the only one that I could say, I don't know, maybe I'll coin a term like the sexy six, because Tesla has definitely lost its way.
Yeah, hey, we have seen widening out. Even look at emerging markets; those have been moving higher in the face of a stronger dollar too. So it's a market here where money is still in the markets, and it continues to widen out. And I think we just keep saying other sectors play catch up, and then that money rotate into other sectors. So again, we can wait for rate cuts all we want, but Joel, as you said, rates could stay higher for longer, stable for longer, and that doesn't necessarily mean that these markets need to fall out of bed or go through any major corrections. I'm sure one eventually will come, but again, it's been a loser's game trying to short the markets and trying to, well, I guess say that it's all bearish out there because these markets are telling a very different story. Joel, thank you very much for your time. Always enjoyable chatting with you. You make us laugh every time we chat. I'll post a link to your pre-market prep website. We'll chat again next week. Thanks, Joel.
Okay. Thank you, guys.